Hi friends, here we are going to take up something on in capital budgeting, a machine which has got 3 years of life as what is the appropriate replacement cycle. So that is the one that we are going to take up for today's discussion, and for that we are going to use equivalent annual benefit. Okay. Now, in order to understand this concept better, it is better that we just go through the problem. Photolysis Limited uses a 10% discount rate for project appraisal. It is considering purchasing a machine which, when it comes to the end of its economic life, is expected to be replaced by identical machine and so on continuously. The machine has a maximum life of 3 years, but as its productivity declines with age, it could be replaced after either just 1 or 2 years. The financial details are as follows. Years, all in figures in thousands, rupees in thousands. Year 0, negative 1000, and revenues for year number 1, 2 and 3 being 900, 800 and 700, cost being 400, 350 and 350 all in the negative, scrap value all in the positive, 650, 400 and 150. What is the appropriate replacement cycle? See, now let us just understand one important thing is that a machine has got 3 alternatives to be dealt with. A machine can be bought now, can be replaced 1 year after its usage, or we can go for 1 more year and it can be replaced 2 years later, or you can give full quota of all the 3 years for its operation. So it is like 3 different machines as machine A, machine B and machine C. Machine A has got 1 year of life and machine B has got 2 years of life and machine C has got 3 years of life. One thing you need to understand is that though we have 3 different machines, or replacement cycle can be converted into 3 different machines. So definitely by using the machine for 3 years, you will have a longer period and greater number of cash flows that would be resulting, and you would end up with a higher NPV naturally for that particular option of replacing every 3 years. So it may not be fair to bring out a comparison on NPV basis alone. So 1 year replacement cycle will have 1 year cash flow and the same amount of cash outflow of 1000. 2 years of life cycle will have 2 years of cash inflow and year 0 as the cash outflow, and year number 3 will have 3 years of cash inflow. So quite naturally, even without computation, we can as well conclude that 3 years replacement cycle will be the best. But thing is that it is not fair to bring out a comparison between 1 year and 1 year life cycle asset with 2 years life cycle asset with 3 years of life cycle asset. It is not fair. It is how it is unfair is like that you take up a 4th standard boy and compare it with the performance of 7th standard boy. So quite naturally 7th standard guy is expected to have better knowledge than the 4th one. That is general expectation is like that. So without even applying capital budgeting technique, we can as well choose 3 years replacement cycle, but it is not fair to bring out based on NPV. So therefore what is that we are expected to do? We are expected to use that what you can call it as a tool as equated annual benefit. What is the formula for equated annual benefit? So equated annual benefit formula is going to be a very simple one only. It is nothing but I would say net present value that you arrive at divided by annuity factor. So it is not to be divided by number of years of life. It should be annuity factor. So we all know in discounting you have a cash flow, you have a PV factor and then discounted cash flow. The sum of the product is nothing but discounted cash flow. The sum of the weight is nothing but your PV factor. So this is sum of the weight. So this is going to be your product. Product divided by sum of the weight is going to give you the average. So it is very much an appropriate thing to use. So equated annual benefit, and whichever replacement cycle gives them the maximum, that is what we are expected to select. So now let us just take up in um, slide 3 as what exactly is going to be the case. The given is all about when machine is to be replaced. So quite naturally when machine is to be replaced. And as I told you, the formula is going to be net present value divided by annuity factor. So we have before us 3 projects. Project number 1, machine replaced every 1 year. Project 2, machine replaced every 2 years. There is project 3, machine replaced every 3 years. Okay. Now a comparison has got to be made, like project 1 having 1 year of life, project 2 having 2 years of life, project 3 having 3 years of life. Okay. So now let us just bring out a normal NPV computation as how we normally do for any case. There is a one that we will be taking up. So 1 year replacement option as project having 1 year of life. This I will just explain, and you can just go through patiently as how things will be carried out. Okay. Consider 3 years replacement cycle as on project having 3 years of life. Okay. So that's the way we will carry out. And then now that the natural computation that we will take up. And before that there is a precaution. So there are 3 projects having different lives. One of them has got to be selected. So which method to be used? This of course we have already brought out our observation that predominantly our inflows are dominant. So equator annual benefit is what we are expected to use. And now let us just take up our computation. So all of you just watch out patiently and closely, and you would automatically be very happy to have the computation drawn in PPT, and the video can be played in fact at your own pace. But thing is that knowledge is very important. Under examination conditions we are expected to execute this. Okay. So now let us just take up the cash flow and the discounted cash flow for each one of those projects. Now let us just take up year 0. The year 0 would mean the time at which investment has got to be made, and our PV factor, whatever may be the rate. In this particular case it is 10%, but whatever may be the cost of capital for year 0, it is going to be 1. Cash flow is 1000 and that is going to be 1000. The same thing is going to be extended for all the 3 projects. I hope that this is not a difficult one. Now it is 0.9091 is the PV factor that you have. The cash flow is 1150. Now how this figure of 1150 has come? So now let us just have a patient understanding about how that 1150 number we have just got it. So it is 900, that being the revenue. To get that 900, 400 is the expenditure that we have incurred, then plus 650, that being the salvage value that we have to take into consideration. So 900 minus 400 plus 650 together comes to 1150, and let us just discount that there, and it becomes 1045 as the discounted cash inflow. And on the same lines, when you take up for project number 2, year number 1, in this particular case we are going to take up the figure as 900 minus 400, that being 500 here. So let us just know as how that 500 has come. 900 as the revenue and the expenses for that, and the 650 will not come here because we are going to take it up only for 2 years replacement cycle. When you are decided to replace every 2 years, naturally the salvage value attributable to year number 1 will not come at all. So this is a very important thing that you got to take up. The next is the computation, that being the cash flow multiplied by PV factor, and the same 500 will come for project 3 also, right? Now let us just take up for year number 2. For year number 2 the PV factor is 0.8264. One important thing is that for project number 1, when you decided to replace every 1 year, you will not have any cash flow for year number 2 at all. So have that in your mind, and that is going to be blank there. And for year number 2, how this number is going to have 850's computation is going to be same way, the revenue, expenditure and the salvage value. So how that has got to be taken up? So it is to be taken up at 800 minus 350 plus 400. See, the font size is a little smaller, so I got to take that extra strain. So for you to view in YouTube, it is not going to take that much of strain, and you will have 702 is the discounted cash inflow, and it is going to be 450. So 450 would mean, so the figure for revenue and the expenditure alone we are expected to take up. We will not be taking up salvage value at all. So that's the way we will take it up, and project 3 will have discounted cash flow in that manner only. Now let us just take up for year number 3, 0.7513. You will not have any updates in year number 1 and 2. Right. Only in year number 3 is going to be there, and it is something on the same lines as we have done for year number 1 and year number 2. What is that we do have? So revenue minus expenditure plus the salvage value, 700 minus 350 plus 150. So if you discount it, it is going to be 376. Now what is that we are expected to do the next? The next is the net present value is what we will be taking up. For 1 year project, it is going to be 45 and 157 for project 2, and it is 203 I should say for project number 3. So upon comparison on an absolute basis, project 3 would be the best because that gives me you the highest NPV. But that is not the way we will take a decision. Now let's just proceed to the last slide. So how we are making the comparison. Annuity factor for all this would mean 0.9091, and 2 years PV factor when you add it is going to be 1.7355. 3 years when you add up it comes to 2.4868. So the respective NPVs are to be divided by the respective annuity factor. You would end up with 49 there, and you would end up with 82 for the last one, and you would just find for project 2 that is going to be a suspense. So now let us just find out as what is that number that we have. So that being 90. How that 90 had just come? 90 is nothing but the net present value as divided by 1.7355. That is the way you just get that 90, and that is being ranked number 1. So having ranked number 1 against project 2, so we have to say that the replacement cycle is going to be 2 years. That is, every 2 years we will be replacing the asset. This is the way we are expected to take up such problems. And let me tell you, this is one of the very important thing that you got to remember whenever we deal with projects with the different lives. And when the cash flows are dominant with outflows, then equated annual cost. In this particular case, inflows are more than outflows. We will just have equated annual benefit as the basis for decision making. Market order is very important. Please do practice this problem before going to the examination. Is that right? Thank you. All the very best.